Hello and welcome to the next of our full course lectures. This lecture is on internal controls. So we're thinking here about the system of internal controls within a business. So what exactly does that mean? Well, remember, under our corporate governance codes, we need the management to be accountable to the shareholders. And part of those corporate governance codes were that management needed to take responsibility for internal controls within the organisation. So think of internal controls as being there to prevent fraud and error. So we want to minimise any fraud that there could potentially be within a business, and we want to prevent any errors from happening within that business. So the directors are responsible for internal controls. Now, they're also responsible for setting up an audit committee. An audit committee will be made up of non-executive directors, and it will oversee the work of, for example, internal audit. And we'll be looking at that in more detail in a later lecture. So directors will set up an audit committee to oversee internal audit, but that doesn't take away from the fact that directors are responsible for internal controls. We're also going to look in detail in our later lectures at risk management within an organisation, because that's linked in with our internal controls system. There should be controls over the risks that we identify through our risk management system. In fact, when it comes to the corporate governance codes, they say that you must have a risk-based approach to internal controls. That means that you need to identify the risks within the organisation, and then you need to design internal controls so that you can reduce those risks. So that risk-based approach must take into account things like the business objectives of the organisation. So you need to look at those objectives and see if maybe those objectives might fail, and that could be a risk. You also need to identify the key risks that that organisation is facing. Then you can design controls to try and reduce those risks. Ultimately, you'll need to get feedback from your risk management system to see whether it's working or not. And we're going to look in great detail at risk management and how an organisation will get risk management ingrained into their systems. So remember, we must have responsibility from the directors for internal controls. That's required under your corporate governance. They will set up an audit committee. They will set up a risk management committee. The risk management committee will identify the key risks in the organisation and then implement controls to try and reduce those risks. So what about this internal control system that we'll expect the organisation to have? Well, the first thing we need to understand is why we need that system at all. And there are some key areas that we need to understand for that. The first of those is that we need to prevent that fraud and error that we already mentioned. So that's the key reason for having our internal controls, to prevent that fraud and error that could happen if we didn't have efficient internal controls. Also, we want to ensure the accuracy of the information coming out of the system. So that's important when it comes to the financial statements. You don't want inaccurate information going into your financial statements, and inaccurate information is more likely if you have insufficient controls. So you need to have those controls in place to make sure that all of the information coming out of your system is accurate and there are no problems with it. Also, we need to safeguard the assets. Remember, this feeds right back to the agency problem. The shareholders are the owners of the business. They therefore own the assets of the business. Management are there to manage those assets, to look after them. And part of that will be having internal controls to keep them safe, to have security over those assets, for example. Lastly, we want to provide accurate and timely information. So having internal controls makes sure that you get the information out of the system. So those are some of the main reasons why we have an internal control system. Some of the objectives of the internal control system that you'll have in place will be, first of all, to have that effective and efficient operation within the business. So that feeds right back to your accuracy of the information, timeliness of the information. You can't have that if you don't have internal controls. So by having internal controls, you make sure that things run smoothly because there are controls to ensure that that happens. You make sure that things run efficiently because the controls are there to make sure that that occurs. So the first objective is to provide effective and efficient operations. Also, that reliable financial reporting. Remember, the information that's coming out of your system is the information that's going to be used to produce the financial statements. So we need reliable information coming out of the system to make sure that our financial reporting is accurate. So that's one of the key objectives of having a good internal control system. Lastly, of course, we need to comply with laws and regulations, and we'll be talking a lot in the future lectures here about internal audit. And one of the key things that they will undertake are compliance audits. They will try to make sure that the laws and regulations that apply to this specific business are adhered to. And to do that, they will implement controls to ensure that that's happening. Now, those are all the reasons that we're going to have an internal control system, but do be aware that there are some limitations to an internal control system. It's not just the end whenever we get it in place. We don't just think, well, nothing can go wrong now that we've got a good internal control system. The first thing is that internal control systems are designed for routine transactions. They're designed for everyday transactions. Now that's fine for everyday transactions, but suddenly if a one-off transaction comes along, sometimes the internal controls aren't designed to deal with that. So they might be designed for day-to-day recording of purchase ledger transactions, but they may not be designed to have controls over the valuation of a financial instrument, for example. So that means that controls can break down for those one-off unusual transactions that you may well have within a business. So that's a limitation of internal controls. Also, there will be a limit to the amount of resources that the business will have available to put towards internal controls. So it has to be cost beneficial. There's no point in putting so many controls in place that it costs so much that you don't make any money anymore. So you may have limited resources with which to actually implement an internal control system. Remember, controls can always be circumvented, particularly if you have collusion between employees. So they perhaps could just get around the controls or indeed just ignore the controls, and that of course will be a problem or a limitation. Lastly, remember, we're reliant on the people who are running the system. They will make errors just like everyone else does. So if there are human errors, that may well feed in and mean that sometimes the controls just do not work. So do be aware that those limitations exist, that the control system is not the be-all and end-all. Of course we should have one in place, but we need to understand that it may and could go wrong. So what makes a good internal control system? Well, the first thing is that your internal control system must relate to risk management. So we're going to talk in detail about risk management in later lectures, but there are three main principles that I want you to remember for a good internal control system. Number one, it has to be embedded in the organisation. Now we'll talk about that in more detail when we go on to talk about the control environment. And that's really the tone that exists within the organisation. We want to try and ensure that everybody in the organisation is aware of the internal control system. They're aware of the controls that apply to them, and not only being aware of them, but they actually do them. Because often it's the case that people are aware that they should be undertaking a control, but they simply don't do it. So the first principle of having a good internal control system is that everybody understands their role in it and everybody buys into having that control system. It also must be able to respond to the risks that we identify. Remember, it must be based on risk, so we must identify risks and then design controls to deal with those risks. And lastly, it must have procedures to report weaknesses. Now that means that if things go wrong, we can find them easily and we can deal with them, rather than just letting them go and the same thing happening over and over again. Well, the procedures need to be there so that if there is a weakness, well then that is reported and dealt with. So as long as an internal control system, broadly speaking, has those three principles, it should work sufficiently. It must be embedded in the organisation, able to respond to the risks identified, and there must be the procedures available to report any weaknesses. So what are the roles when it comes to this internal control system? So we're going to identify various parties within the organisation. We're going to think about what their role will be when it comes to internal controls, because when they take that role on, well then they have responsibility in that area. So if there are problems, well then we know who to talk to about it. So first of all, starting with the CEO, the Chief Executive Officer. Remember, this is the person at the top. This is the person that is going to set the tone within the organisation. Again, we're going to talk about this when we look at the control environment. Often the control environment is set from the top of the organisation. So if the CEO acts with integrity and adheres to an ethical code, well then it's more likely that that will feed down through the organisation, and those below the CEO will also act in an ethical manner and act with integrity. So remember that the CEO is going to set the tone for the internal controls in the organisation. What about the rest of the board then? Well, remember, the board are responsible for internal controls under our corporate governance rules. So the board are going to set the policies and procedures that are there within the organisation. They need to not only set them, but they need to ensure that they're adequate. So they'll have an internal audit function usually, remember, and they'll make that internal audit function so that it can go and check that controls within the organisation are adequate. They'll also make sure that the resources are available so that internal controls are put in place. Remember, we said one of the limitations to internal controls was if we maybe didn't have enough resources. Well, that's the board need to take responsibility for that. They will provide the resources for internal controls. The risk committee that we will meet in detail later, well, they're the ones that will set the risk strategy. They'll be the ones responsible for looking at the risks of the organisation and then thinking about internal controls that will deal with those risks. Senior management then, well, remember, the board will charge senior management with implementing the internal controls that they've come up with. So senior management will provide the information to the board as to whether those controls are working. They'll also monitor the controls on a daily basis to ensure that they are working. Internal audit we're going to talk about in detail in the next few lectures. They will evaluate and report on internal controls. They will look at different sectors of the organisation. They'll assess the internal controls and they'll tell the audit committee whether those internal controls are working or not. They'll make a report and they'll make recommendations to maybe improve the controls in that area. Lastly, the employees. So the employees are all important. They're the ones that will actually have to act within the control system. So they will have to implement the controls, they will have to act within those controls, and they should report any weaknesses if they find them. If they think a control isn't working as it should, well then they need to report that to the senior management. The senior management then report that to the board, and that is how the internal control system will work. So make sure that you understand those various roles within the organisation. Let's look now at illustration 1. So we have a scenario again. So read through the scenario and then have a go at the question. We have here a bit of an introduction to internal audit as well as talking about internal controls. So we're going to go through the answer and make sure that we learn about both those areas. The requirement in illustration 1 is as follows. It's to describe 5 general objectives of internal control. So looking at 5 of these objectives, the first one is that we can ensure orderly and efficient conduct of business in respect of systems being in place and fully implemented. Control, of course, means that the business processes and transactions take place without disruption, and that means less risk and disturbance, and that in turn will add value and create shareholder value. So remember, what we're looking for here is a system that works well, that reduces the risk of fraud and error, and because there's less fraud and error, we get more value. And remember, that's what we're there for. We're there to create shareholder value. We also, of course, want to safeguard the assets of the business. Remember, back to the agency problem. The assets will include the intangibles and tangibles. The controls will be necessary, therefore, to make sure that they are protected from misuse, fraud, or indeed theft. So we need to make sure that we're safeguarding those assets. Remember, the assets are owned by the shareholders. They own the assets. Management are looking after them. Also, to prevent and detect fraud, the controls will be necessary to show up any operational or financial disagreements that might be the result of theft or fraud. So that might be off-balance sheet financing, use of unauthorised accounting policies, inventory controls, use of company policy and property, and everything else that could entail. So if we have the controls in place, that will prevent and detect the fraud before it actually happens. It's also to ensure the completeness and accuracy of accounting records. Having those controls in place will ensure that all of the accounting transactions are fully and accurately recorded. It'll also make sure that the assets and liabilities are correctly identified and valued, and that all costs and revenues can be fully accounted for. Lastly, the controls will be there to ensure timely preparation of financial information, which applies to statutory reporting, for example, of year-end accounts. Also for management accounts, so that the business can make decisions based upon it, and make sure that those decisions are effective. So 5 general objectives: to ensure orderly and efficient business, to safeguard the assets of the business, to prevent and detect fraud, to ensure completeness and accuracy, and to ensure the timely preparation of the data. There are other ones, so you could have come up with those, but those are the 5 that are in this answer. So we should now understand what a good internal control system is. We also need to now think about some of the requirements for it. So I just want you to remember under Sarbanes-Oxley, remember we shortened that to SOX, and we said that under Sarbanes-Oxley, the management have to take legal responsibility for internal controls. Remember, that's slightly different from the UK Corporate Governance Code, where you're not taking legal responsibility. You can't be prosecuted if you don't undertake good internal controls. So what management will have to do under Sarbanes-Oxley is to evaluate the weaknesses in internal controls, and they have to give an annual report on that. So it's not just a case of them having the system. They need to evaluate the weaknesses within the system, and they need to have an annual report on that. Also, when it comes to the auditor, remember they give their opinion on the internal controls, not just the financial statements as you would expect. So they also give an opinion on the internal controls. So those are some specific requirements under Sarbanes-Oxley I just wanted to remind you of. So one of the key things with internal controls is that they need to be reviewed. So internal controls must be reviewed, and this should be done annually. So management is responsible for doing this. They need to take an annual look at the internal controls within the organisation, and they'll need to undertake a review that they report on in the annual report. So they will have an internal control review in the annual report. So there's a few elements that they'll be looking for when they do this review. So if you were looking for the elements of a good internal control system, the 5 things you'd be looking for were, first of all, the control environment. So we already discussed this when we looked at the roles of different people within the organisation. Remember we said that the CEO sets the tone for the organisation. Well, that tone could be referred to as the control environment. So it's set at the top, and it's really a philosophy or style. So it's how that organisation is run, how those within that organisation see internal controls. Do they see internal controls as important, as something that's integral to the organisation, or are they not that bothered? So that control environment will be set from the top, and it's really thinking about how that organisation is structured. In bureaucratic organisations, for example, you will tend to have a lot more controls, so that could be seen to have a stronger control environment. But that's not necessarily the case. It will depend on each organisation. So that's the first element of a good control system. The second is a risk assessment system. Remember, there needs to be a risk-focused control environment. So that risk assessment will look at internal and external factors. It'll also look at controllable and uncontrollable factors and try to have internal controls in place to deal with those risks. And again, we'll look at this in much more detail in a later lecture. So when we're looking at the controls in place, what should we expect to see? Well, we should expect to see the following control activities within the organisation. Number one, segregation of duties. Segregation of duties means that we split out the operations between various people. For example, in our cash system, we won't have one person who both collects the cash, counts the cash, and brings that cash to the bank, because there's a risk then that that cash could go missing in between it being counted and taken to the bank. So what we'll have is one person collects the cash, one person counts the cash, and another takes it to the bank. That is segregation of duties, not having one person doing all of the roles within the system. Also, we should have sufficient training and human resources, policies and procedures in order to make sure that people are, number one, aware of internal controls, and number two, they know that there will be something that happens if they don't implement the internal controls through human resources, policies and procedures. There will be arithmetical checks, so things like bank reconciliations will be done. There will be physical controls, so you may not be able to access certain areas of the building, for example, where sensitive information or sensitive assets are kept. There will be authorization, for example, authorization of invoices. So you maybe have an authorized manager who can sign off on an invoice of a certain size, for example. There'll be supervision of trainees, for example, to make sure that things are done correctly, to make sure that internal controls are observed. And of course, you'll have more supervision. I can't stress that enough. Supervision is absolutely crucial to this. There needs to be supervised activities at every level within the organisation. So that's why we've got it in there twice. Okay, so when we're looking at these 5 elements, the fourth of them is our information and communication systems. So that's how we go about gathering the information and communicating the information throughout the organisation. So by having a good system that makes sure that everyone's aware of the internal controls that should be in place, they're more likely to be adhered to. Lastly, monitoring. That monitoring will be carried out by the internal audit function and the audit committee, and we're going to go on to look at those in a lot more detail in the next 2 lectures. So now that we understand the elements of a good control system, we need to think more about the information that comes out of that system. Remember that we want all of our control systems to be adequate because we need information that is accurate and dependable to come out of that system. So the importance of information to the system the main thing is that we need information to perform daily tasks. So within the organisation, we need good information to come out to make sure that all of the daily tasks are performed accurately and efficiently. We also need that information to monitor performance. Remember, we said one of the key things about having a good internal control system was to monitor it. Well, we can't monitor it if we don't get the information out of it to actually assess. So ultimately, we need that information to make decisions and, more importantly, to make good decisions. So what about the information that we can get out of the system? What types are there? Well, the requirement depends on the management level that is using the information. So different management levels will need different types of information. So for example, the strategic management team, that's the board within the organization. Well, they will need a wide range of information. So they'll need information on all parts of the organization because remember, they will be making decisions about the strategic direction of the organization. That means that they need information from all parts to make sure that they're getting a view that encompasses the whole organization. So the strategic level management team will be the board and it will need all information that is pertinent to strategic decisions. When it comes to the tactical management team, so this would be the senior managers, but maybe not quite at the board level. So they'll be more interested in getting current data for their particular area, and they'll be interested in identifying trends and relationships in that area to see whether they can do things like do better cost control. When it comes to an operational level, well, this is where they simply need the simplest type of data. They need information about sales, about purchases, about the stuff that happens right down at an operational level. So do be aware of the different types of information that are required within the organization. You also need to remember that information must be accurate. So accurate information will need to come out of the system. So that's the first thing that information needs to be. But it also needs to be some other things. It needs to be complete. We need to get information that shows the whole picture. There's no point in getting information that only shows us one side or doesn't give us a complete picture of what's actually happening. It also needs to be cost beneficial. We talked about this when we looked at controls. We said that there's no point in implementing a control that costs more to implement than it reduces the cost of something happening. So anything that we're using, any information that we're using must be cost beneficial to actually achieve. It also needs to be user targeted, so we need to think about who's going to use the information and make sure that it is appropriate for that user. It needs to be relevant to that user. It needs to make sure that it covers everything that user requires and doesn't bring in things that aren't relevant to them. It needs to be authoritative, i.e. it needs to have the clout that it requires. It needs to have all of the information available to that person, and it needs to do it in an authoritative way. It also needs to be timely. So information must be timely, i.e. there's no point in giving someone information from last year or last month if they need real-time data. Lastly, it needs to be easy to use. So the information that you're using needs to have that ease of use. It needs to maybe have some sort of system that presents it in a user-friendly way. So all of those things must be there for information to be usable. So how, as an organization, are we going to get this information? Well, we're going to get it from various different systems within the organization. So those different systems are, first of all, your EIS. An EIS is an executive information system. So this is for those board members. Remember, they needed a wide range of information from all parts of the organization. So that system is going to cover all of the business, and it's going to do it in real time so that the executives, the board members, can make those crucial decisions in real time. Also then we'll have our management information system, our MIS, and that's going to convert the data within the organization into information. Remember, data is the raw data coming through from maybe your purchasing system. To turn that information, to turn it into something usable, well, we need to actually have a system that takes it, breaks it down, and maybe shows it in a user-friendly way in maybe a graphical or report format. And that's your management information system that does that. A DSS is a decision support system. That's just something that you can plug in information and analyze it to make decisions. For example, a spreadsheet. And lastly, your TPS is your transactional processing system. So the information from this would go into your management information system to convert into usable information. So this is just the system that captures the data. That might be the till system that's down on the shop floor that gets all of the data that's then used in some of the more involved information systems like the management information system to actually convert that data into information. So hopefully now you can see the linkages between the controls that we have within a system and the information that comes out of that system. We need to have strong controls so that the information meets all of the criteria that we need it to meet. So that was our lecture on internal controls. We're going to look at this in more detail when we move on to look at risk management.